the Continental Tantrum. Europe and America are having a bit of a domestic spat over Greenland, and things have escalated faster than a Twitter feud. European policymakers, feeling a bit ignored, are scrambling to find any leverage over Trump's America. Suddenly, someone looked at the books and realized, wait, we basically own their soul. We're talking about trillions of dollars in American assets sitting in European pockets, including a cool couple trillion in US government bonds. The big, scary idea? A coordinated sell-off. It's the financial equivalent of, I'm taking my ball and going home. But the ball is the global economy. The panic button. If Europe actually pulled the trigger, it could spark a full-blown panic in US markets and shove the American government into a debt crisis faster than you can say fiscal cliff. Now, this might sound like a fever dream from a disgruntled Brussels bureaucrat, but it gained enough traction that Treasury Secretary Scott Bessent actually had to address it. His professional advice? He basically told Europe to take a deep breath and stop being so illogical. So in this video, we are asking, can Europe actually dump US assets? The short answer is probably not, but there are plenty of other ways they can weaponize America's underappreciated dependence on European cash. The trillion-dollar hook. To get why this is a big deal, you have to look at the receipts. Europeans own a staggering amount of the American dream. According to the Financial Times, European NATO members alone hold about $12.6 trillion in US assets. That's about a third of all foreign holdings. Basically, Europe is America's biggest silent partner. Most of this is tied up in US stocks because Europeans love the S&P 500. But they also sit on $2.8 trillion in US treasuries, which is 10% of the entire US debt market. The bond market hostage. Now, for a quick refresher, government bonds are how states borrow money. You pay cash now, get some interest, and eventually get your face value back. But here's the kicker. When investors lose confidence and start selling, bond prices drop, and yields, the effective interest rate, spike. For the US government, this is a nightmare. America's debt to GDP ratio is already hovering at a spicy 120%. The annual deficit is at 6%, and the 10-year Treasury yield is already sitting at 4.3%. A sudden spike in yields would make borrowing and servicing that debt insanely expensive, potentially triggering an acute fiscal crisis. The 3 reasons why they won't. So, is Europe ready to press the delete button on the US economy? Not quite. There are 3 massive problems. First, most of this money isn't actually owned by governments. It's owned by the private sector. It's hard to imagine European leaders forcing private investors to sell their portfolios without some unprecedented and probably illegal intervention. Second, dumping assets at this scale is a fire sale. Europe would have to sell at such steep discounts that they'd be lighting their own money on fire. Finally, a Treasury crisis wouldn't stay in New York. It would hop the Atlantic instantly. Our financial systems are so interconnected that when the US trooped in 2008, European banks were the ones who fell down the stairs. Back then, half of the Fed's emergency liquidity went to European institutions. In reality, the Fed is Europe's backstop. A mass sell-off would be mutually assured destruction, the financial version of a nuclear strike.
The polite way to weaponize money. That doesn't mean Europe is toothless. They have less extreme options to make life difficult. First, they could do a managed sell-off of public sector holdings, like sovereign wealth funds. This wouldn't blow up the world, but it would steadily push US borrowing costs higher, giving Europe some quiet leverage in negotiations.
Second, they could get bureaucratic. The European Central Bank could decide that US treasuries aren't risk-free anymore, giving them a non-zero risk weight. This would make them less attractive to banks and discourage anyone from holding them. Lastly, they can target the stock market. European governments could offer tax incentives to keep capital at home rather than sending it to the S&P 500.
The US already does this by exempting Treasury interest from state taxes, so it's not even that radical. Given how stretched US stock valuations are right now, a significant shift in European capital can puncture the market bubble and damage the US economy without the messy global collapse side effects.